Build calm conviction by knowing what you own and why. If day 2 was about plugging leaks, today we start building the engine. Not the fantasy engine you see in Instagram reels, but a grounded, values-aligned investment system that won't panic at the first headline. I'm not here to give you stock tips, I'm here to give you a map. When you understand the handful of asset classes that drive 99% of wealth outcomes, and the risks baked into each, you stop reacting and start designing. Think of your money like a cricket squad. Every player has a role. Equities are your aggressive batsmen, volatile in the short term, but the ones that put runs on the board over years. Debt is your dependable all-rounder, doesn't thrill the stadium, stabilizes the innings. Gold is your crisis specialist, walks in when the pitch turns ugly and the ball is swinging. Real estate is the sturdy opener, slow to start, but occupies the crease and tires out the opposition. Cash is your 12th man, always ready, rarely glamorous, absolutely essential. That's the spirit of the 5 core asset classes we'll use: equity, fixed income, debt, gold and silver, real estate, and cash or cash equivalents. My book lays this out clearly, and I want you to anchor on those exact roles rather than internet noise. Equities are the long-term growth driver with higher short-term volatility. Fixed income provides predictable returns and balances equity swings. Gold and silver hedge inflation and uncertainty. Real estate is tangible, income-producing yet illiquid. Cash is the safety net and liquidity provider. Before we touch products, lock in this mental model. Goals and time horizon decide the mix. Short-term goals demand stability and quick access, so they lean on cash and quality fixed income. Long-term goals deserve growth drivers, equity, and where appropriate, real estate. Mid-term goals sit in the middle with a blend. This is not motivational theory, it's the backbone of calm investing. You are matching the character of the money to the job it must do. My book literally spells this out. Short-term aims favor cash and fixed income, long-term tilt toward equities and real estate, mid-term seeks a balance. Now, risk. Most people say they're risk-averse until they see last year's top-performing fund, then, suddenly, they're risk-curious. Let's cut the drama. Risk isn't a villain, it's a set of specific forces you can understand and manage. Market risk is the big weather system that hits everyone: interest rates, inflation waves, geopolitical shocks. You can't avoid it, but you can diversify, invest with a long horizon, and use periodic investing to smooth the ride. Inflation risk is the silent thief. Fixed income and cash struggle to outrun it, which is why growth assets matter if your goals are years away. Credit risk is the chance a borrower won't pay you back. That's why quality and diversification matter inside debt. These are not pet theories, they're the exact risk lenses my book teaches, along with practical mitigations like diversification, long-term focus, SIPs, and matching instruments to inflation realities. Let's humanize each asset class with Indian life snapshots. Equities: are you owning the growth of businesses? In any given year, they can feel like a roller coaster. Over a decade, they tend to reflect enterprise growth and productivity. That's why equities belong to your long-term buckets. They compound when you give them time and discipline. Debt is the instrument you lean on for predictability: government bonds, high-quality corporate bonds, and target maturity funds that keep volatility in check. My book even breaks down the stability spectrum inside debt and shows how duration changes interest rate sensitivity. Shorter duration is steadier, longer duration seeks a bit more return but wobbles more when rates move. Gold and silver are not there to beat equity, they are there to protect purchasing power when the world wobbles. They don't pay income, and that's okay, their job is insurance and low correlation. When equities are bleeding in a panic, you'll bless the allocation to your crisis hedge. Real estate in India is a love language, but in portfolios it's a tool: income plus potential appreciation, with real costs, lower liquidity, and concentration risk if you go all in on one house. Cash is for the shock absorber, emergencies, opportunities, and sleeping well at night. The book's guidance is practical. Keep a measured slice for emergencies and optionality. Don't park your future in a savings account and call it a plan. Asset allocation is where this all becomes your system. The reason you spread across these classes is simple. Different players perform in different economic cycles. Booms favor equities, downturns reward gold and quality fixed income, steady times keep real estate and commodities quietly useful. A balanced spread reduces the chance that one bad bet sinks your long-term plan. My book emphasizes this across cycles, logic, and then brings it back to you, your goals, your risk tolerance, your horizon, and even shows sample mixes and pitfalls to avoid, like over-concentration, ignoring liquidity needs, chasing trends, and forgetting to rebalance. Here's how we'll use this in your real life, starting today. First, we'll classify what you already own by asset class without judging whether it's good or bad. This neutral clarity is an antidote to shame and hype. Then we'll eyeball whether you are overweight or underweight purely by feel, not by some guru's template. Later in the program we'll bring in sharper numbers, risk bands, and rebalancing rules, but for now, I want your honest snapshot, not a performative spreadsheet. Open your workbook and turn to Know Your Instruments. In the equity box, write the vehicles you actually hold: large cap index funds, flexi cap funds, ESOPs, direct stocks if any. In the debt box, write FDs, EPF/PPF, target maturity funds, government or PSU bond funds, NPS debt tiers. In the gold box, add SGBs, ETFs, physical. In the real estate box, add your home, an investment flat, plot, or REITs. In the cash box, capture savings accounts, sweep FDs, and liquid funds. You don't need exact rupee amounts yet. If you know them, great. If not, a rough sense is enough. This is in line with the book's approach of listing what exists before slicing and dicing, and it's the quickest route to an honest baseline. Now, below those boxes, write one line on your current tilt. If you had to guess, are you equity heavy because you chased returns in a bull market? Are you property heavy because of family preferences? Are you cash heavy because markets scared you and you never re-entered? There's no scolding here, there's only design. Your future allocation will be tailored to your goals and time horizons, with room to breathe during storms and enough offense to outrun inflation. That is the exact philosophy you'll see repeated in weeks 14 to 17 of the full program: asset classes first, risk handled up front, goals and horizon as the boss, then a personal policy and a simple review rhythm. Let me give you a taste of how this clarity changes behavior. When a colleague brags about a small cap fund that doubled, you won't feel compelled to copy it. You'll ask, does my long-term bucket need more equity exposure, or is this just performance chasing? When headlines scream about rate cuts or hikes, you won't yank money randomly. You'll know which part of your debt exposure is short duration versus long duration and why you chose it. When a cousin pitches a can't lose plot, you'll weigh it against liquidity needs, concentration risk, and the true work of being a landlord. And when cash piles up after a bonus, you'll top up your emergency tier and then feed the right buckets, on purpose. Close this video by writing 2 reflections. First, the asset class I've misunderstood the most is blank, and here's the cost of that misunderstanding. Be brutally honest. Second, if I aligned my investments to goal timelines instead of moods, the first change I would make is blank. Give me 1 sentence, not a paragraph. Then complete the workbook prompts. List your current instruments under each asset class, and mark by feeling where you are overweight and underweight. We'll convert this feeling into a policy in the next phases. The point, today, is to replace noise with structure. When you know the roles, respect the risks, and let time horizon drive your allocation, you don't need to predict the market. You just need to keep your squad on the field and stick to the game plan.